What's up, my friends? John Baruti here, Baruti Success. This week we are talking about how to invest $1 million.
$1 million.
Yeah, stay tuned. What's up, my friends? If you're new here, this is Baruti Success. We talk about everything to make you more successful. We talk about investing, we talk about entrepreneurship, we talk about business, we talk about everything that made me over the last 30 plus years successful to hopefully help you become more successful. Faster, quicker, less pain than I went through. So that being said, make sure you subscribe, right? And click the bell, because that will remind you when I'm here live in person, so you can watch this, so you could become more successful. Okay? Here we go. So this week, we are talking about how do we invest $1 million, John? How do we do it?
Oh my God, you've gone off the deep end, John. $1 million? I got $50 in the bank account.
Okay, I understand that, Sally. I see you, Bob. I see you back there, shaking your head. Kevin, I understand. Skeptical, over there, almost walking out the door. I get you all. I understand you all. Why am I talking about investing $1 million? Well, my friends, I'll tell you this, and this is what a lot of people don't understand. Investing $1 million is basically the same as investing $100 a week. What? John, that's impossible. Bazillionaires invest way differently than us peasants, right? That, my friend Charles, would be wrong. If you have $100 a week, if you're investing $1 million, if you're investing $30 million, $50 million, all the same, okay? When you get up into the hundreds, you might want to buy a business here or there. You know, you might want to do a syndicated real estate deal. But in essence, if you want to just basically invest and forget it and have an easier life, you'll do what we're going to explain today. Okay? So I just wanted everybody to realize that, because everybody gets so crazy when we get into the bigger numbers. That being said, there are many people that have been fortunate enough to sell their businesses, sell properties, get inheritances. And I will be the first one to say thank you to family members for, foregoing inheritances to me and my family. Very, very fortunate. So you take inheritances, you take business being sold, you take life events, I don't know, maybe somebody, God forbid, passed away in your life, and you've gotten a large sum of money. Let's say you won the lottery, Jane. So your question again is, how do I invest $1 million, $10 million, $20 million, $60 million, John? How do we do it? How? Tell me, please. Okay, no problem. We're gonna go through it in this video, so stay tuned. All right? So first thing I want to talk about is a outstanding free tool. As we all know, I love free tools, because I don't like paying for stuff, because I might be a millionaire, but I'm cheap. Okay? So, a free tool that you and I can use to go over different scenarios on any kind of investing. Dollar cost averaging, lump sum, we're putting $1 million in the market. It's called Portfolio Visualizer. Terrific tool. You can go portfoliovisualizer.com, sign up, it's free. Yes, there's paid versions, but you don't need any of that. You could just do the free version. So we're going to go into that right now. So if we go down and we are in portfolio, backtest portfolio asset allocations. Okay, so what is this video about? Well, Jane, this video is about investing $1 million. And how should we do it? Well, I gotta be honest with you. I'm gonna give you four scenarios on how to invest. If you've watched me for 2 seconds, you already know that I'm an all-in stock market guy. There are many different publications that have tested, all of the different scenarios. The three I'm going to give you today, obviously, the one I believe in, which is keep your money all in the stock market, especially over long periods of time. Okay, and to be honest with you, I'm going to put this right down below in the notes. So this paper that I came across, which is an awesome article on retirement and investing long term, is called The Retirement Glide Path, an International Perspective. This paper was done by a gentleman, I believe he was a professor, Xavier Estrada. Okay, this was done back in 2015, July 2015. This is just another paper that, again, proves that all stock market investing is, and I want to preface this by saying, is the best way to invest, but that's subjective, and that's kind of what this whole video is going to be about. So numbers for numbers over a long period of time. And this particular article talks about glide paths. And if you read it, it talks about increasing glide paths, steady glide paths, and decreasing glide paths, which means after your retirement, what's your glide path in a stock ratio? Are you increasing the amount of stocks that you have, decreasing the amount of stocks that you have, or keeping the amount of stocks that you have as opposed to bonds and other less risky investments, okay? And I'm not going to bore you with all the gazillion pages. The end-all, be-all, the spoiler alert is stocks. All stocks, including after you retire, including the whole time after you retire. That whole, we've been taught our whole lives, well, you should be 80-20, 80% stocks, 20% bonds. You should be 70-30. As you get older, you should be 60-40, 60% stocks, 40% bonds. Yeah, that's all bull dinky. But, and I emphasize the but, here's the problem. The problem is we are human, and humans don't make good decisions. We just don't. So, that being said, and I'm going to pop back over to the backtest portfolio for Portfolio Visualizer. That being said, theoretically, numbers for numbers, staying invested in all stocks from the time that you start to the time that you finish, the time that you depart this wonderful earth, you should technically be in stocks. No bonds. The problem with this theory is most people, including my wife, my mom, probably my dad if he was alive, my sister, good friends, not everybody is a mental patient like I am. Listen, my portfolio is down hundreds of thousands of dollars right now. Yeah, not good. But I'm not freaking out. I honestly don't care. And I don't care probably because, I'm fortunate enough to have enough money to sustain my life every day that I don't have to go to those investments. And that is a key thing here in this conversation, okay? If you are a retiree and you live and die by those numbers, you live and die by how much you can take out of your account every month, right? Let's say you're on Social Security. Let's call it $1,000 a month, but you're spending $3,000 a month. So you need $2,000 a month from your investments. And let's assume you have $1 million in the bank. And you see that $1 million when you go on your online or whatever it is, TD Ameritrade, Schwab, I don't care what it is, M1 Finance, and you see that gigantic number, all of a sudden, not say $1 million anymore. Now it says $750,000. You are freaking out. Sally, you're freaking out. Mental patient, I'm like, oh, look at that. I could buy more stuff and make more money. But that's not the normal person. I've been doing this my whole entire life. I get excited when things go down because it means I can buy. That is not the normal. And even me, I get very rattled, right? 2008, 9, and 10, I was in business. And I was more worried about how my business was going to survive than my assets. But, I get rattled. I'm normal. I'm human. We're all human. So that being said, I've given us 4 scenarios here of how to invest $1 million, because that's what this video is about, okay? And we're going to talk about the different 4 scenarios. The first scenario, right, is called the Boglehead 3-fund scenario. What is a Boglehead? Well, let me tell you. Jack Bogle, a gentleman that I've read about, and a person that was a phenomenal investor. Jack Bogle created Vanguard, and if you know anything about my channel, I shout to the mountaintops about Vanguard. Why? Mainly because they are the cheapest, one of the cheapest out there as far as fees, right? Secondly, they were always managed tremendously. Most of the things that I talk about are ETFs, exchange traded funds, which there's no genius in them. They just follow markets, like the VOO that I always am telling you to invest in. That's the Vanguard Standard & Poor's 500. All it does is follow the Standard & Poor's 500. They don't need to be geniuses about what it's doing. All they need to do is model the Standard & Poor's 500, which is the country's, United States' 500 largest companies and best companies. That's what it is, S&P 500. So the ETF doesn't really have to do too much, okay? Now, that being said, in here, let's go back to our portfolio visualizer. You're gonna see portfolio 1 is the Boglehead 3 fund, which is basically 3 funds. The problem here is that what you see on the screen are mutual funds. They're not the ETFs. They're Vanguard mutual funds, but listen, 40 years ago, there was nobody had an ETF. There was no such thing as an exchange traded fund. And these things have been around since, 70s, the early 70s, right? So there was only mutual funds. There's no reason for you to pay for a mutual fund. Even the Vanguard mutual funds are more expensive than the Vanguard ETFs. So what I'm trying to explain to you is you're going to see portfolio 1 here. And you're going to see 3 different mutual funds. VTSMX, right? Which is basically the Vanguard's VTI, which is the whole stock market. There's the VOO, which I like investing in, which is the Standard & Poor's 500. Then there's the VTI, Vanguard Total Index, Total Investment, Total Stock Market Fund, okay? Which is basically what Jack Bogle is telling you to do. Real short note, VOO and VTI have tracked each other like 2 twins for the last 50, 60 years, okay? I like the Standard & Poor's 500. It has a little less volatility. There's larger companies. There's not a lot of volatility. The VTI, which is the whole stock market fund, has those smaller companies, a little more volatile. That being said, if you see a chart, they match each other almost tick for tick. So I like VOO. So instead of 50% here, right, in the visualizer, instead of this being 50% of VTSMX, it would be 50% of VTI. Same thing, one's a mutual fund, one's an ETF. Next is the VGTSX, right? Now, international. So the VGTSX is the international whole market. That's the whole world, right? That's Vanguard's whole world mutual fund. The ETF that is exactly like that is VXUS, okay? So again, you can't go on to Ameritrade, TD Ameritrade, and buy VGTSX. You can't do it. You can go to Vanguard and buy it, right? Because it's a proprietary mutual fund, but you can't go on a regular exchange or regular broker and buy that. You can buy the ETF, which is what I'm telling you. Okay, so the VTF would be VXUS. And then the next one, again, this is the first portfolio. I'm just giving you what we're going to compare today, is VBMFX. That's Vanguard's mutual fund total bond market. Okay, now the ETF for that is BXUS. BND is Vanguard's total bond market ETF. Okay, so I'm just, again, you're going to look on here, you're going to try to go to whatever platform you're on, Robinhood or M1 Finance, and try to buy these top 3 mutual funds. You can't do it. You can go to Vanguard and buy them, but you shouldn't go to Vanguard and buy them because their fees are a little higher than buying the same exact ETF, which is lower. Okay? Just wanted to explain that. I understand it, it could be a little wonky. If you have any questions, make sure you ask them. I'll try to, be as explicit as possible. So Portfolio 1 is the Boglehead 3 fund. Those 3 funds, 50% in the total stock market, 30% in the international stock market, which is everything, the whole world, and 20% in bonds. That is our portfolio number 1. The portfolio number 2 that we're going to be comparing today is the Harry Browne Permanent Portfolio. Well, who's Harry Browne, John? Harry Browne was a writer. He wrote all types of books. He was an investment advisor, wrote investment advisor books, and he did the study on what he called the permanent portfolio. He wrote a book on it. He was also a presidential candidate. He was also a libertarian presidential candidate. But basically, he was a very smart investor. And if you go to Portfolio Visualizer, and if you break down, see right next to the portfolios, it gives you all these, right? So let's go and find it. Right, so all of these different portfolios are scenarios. I chose these 3 because I personally feel they're the best, and I already weighted them against each other and realized that, there's Bill Bernstein no-brainer. There's Boglehead 4 funds, which is, again, Jack Bogle. Instead of 3 funds, he gives you 4. So I've already tested all these. These 3 that I'm picking, I believe, are the best. That being said, I believe in all stock market, the VOO investment, which is, you're going to see the benchmark. VOO is a Standard & Poor's 500. Comparing all of these against VOO wins out every single time. But the problem with that is, let's get back to this. Hold on one second. Okay, Harry Browne, okay? Permanent is number 2. Okay, now, what Harry Browne was investing in is different, obviously, from the Boglehead. He basically did 4 different slices, 4 different investments. First was VTI, total stock market, right? The second was the TLT, is the iShares 20+ Treasury Bond ETF. Again, so some people, as Mr. Browne is showing you, believe in bonds, having a portfolio that's balanced with stocks, bonds, gold, cash, so on and so forth. So what he is doing is he's putting 25% into 20+ year Treasury bonds, okay? And that is TLT. Then he's putting 25% in cash, just basic cash, right? And then he's putting 25% in a gold ETF, GLD. And again, we're going to see the scenarios. I'm going to show you what the scenarios are. So again, 25% in total stock market, 25% in plus 20-year bonds, 25% in cash, 25% in gold, okay? That's what Mr. Browne believed in. That's what that was his case study. Then, portfolio number 3, we have our famous Ray Dalio. Listen, if you haven't heard of Ray Dalio, you probably, to be honest, I don't know, you should have heard of Ray Dalio. The guy's on every TV show. He's on CNBC. He's been on Good Morning America. Why? Why is it? Because he's one of the most successful fund traders in history, okay? Trillions this guy has been responsible for, okay? So this one is called, I believe, Ray Dalio's All Seasons Portfolio, okay? Now, what Ray is investing in is 30% VTI. VTI is, again, Vanguard's total stock market. 40% in TLT, again, 20-year plus bonds, okay? Then he's getting 7.5% in gold. He's doing 15% in IEF. Let's go see what IEF is. 15% in IEF. IEF. All right. 7 and 10. Okay, again, treasury bonds. So 7 to 10 year treasury bonds. Safe stuff. Okay, so that was his 15%. Okay, then he's got another 7.5% in DBC. Let's go see what DBC is. DBC. Stop. I believe that's also treasuries. No, okay, DBC. So he is investing in commodities. Again, yes, gold is a commodity, but he's investing in, so this is total commodity fund. Oil, wood, pig futures, commodities, okay? So again, he's being much more diversified. So let's go back. So the Ray Dalio fund, 5 different markets, okay? All of these obviously add up to 100%. And then you have me, which is, again, strictly VOO, the stock market. Okay, so let's analyze. $1 million? Let's run it. Oh, and just so you know, I'm running this from it says 1985 on top here, okay? But let me just explain. I'm going to show you this. It says 85, but it's not 85, and I'm going to show you why. So analyze the report. So first, let's go down and see what it's actually to. Okay, so the reason it can't do 1985, it can do from January 2007 to February 2022. Okay, and the reason being is because a couple of the funds didn't exist that long. Okay, so it can only analyze for this time period. This is 15 years. Okay, so we're assuming, because we can only do the analysis because some of these funds, Dalio and the Brown portfolio, have investments in it that have only been around for 15 years. So this is a 15-year, $1 million lump sum investment, 15 years. Okay? Here we go. So the Boglehead, right, is 2.8 million. Okay? Nice. Harry Brown, 2.7 million. Not as great, but not horrible. Ray Dalio, 3,075,000. Pretty damn good. And then mine, the Vanguard 500, is 4,126,000. As I said, the VOO gets us the best returns. But look, here's the catch. STDEV, right? Standard deviation. This line right here basically means volatility. So, over that 15 years, which one of these has the least volatility? Well, it's Harry Brown, and that was 2.7 million. And then second was the Ray Dalio. So the two portfolios that were diversified the most had the least amount of volatility. Now, you might say to me, John, I don't care, 2.7 million, I'll take 2.7 million because it's less volatility. Yeah. And this is what I would tell my wife, my mother, sister, anybody that's not as crazy, let's put it that, crazy as me. Because the worst scenario here is it goes down, the stock market goes down like in 2008, 9, and 10, right? And you pull all your money out. That would be devastating to this. You have to keep your money in. And even better than keeping your money in is putting money in every month, okay? I'm going to show you a couple of scenarios here. Because, again, I hear you, Sally. Not everybody has $1 million. But this is for that person that has gotten a windfall, won the lottery, had an inheritance, sold businesses, sold property, and now they have a lump sum, and, they're looking to invest. And the problem is, if you go to an advisor, God bless them, but you go to an advisor and they want to put you in these things that, I got to be honest, they're stupid. They put you in these things that make them money, not you. None of these things, zero of any of these investments are going to make your investment advisor money. None of them. They're not even going to sell them to you. They're not even going to steer you to any of these because the fees are almost zero. And that's why I want you in these, and I don't want you listening to an advisor. I have an advisor, and I'll put it down below. Oh my God, it escapes me right now. But the reason I love the guys that I use, Facet Wealth. Okay, and I'm going to put the link below. Facet Wealth, basically, you pay them a fee. And depending on how much your assets are and how much you make per year, they give you a fee, right? Out of respect to them, I'm not going to tell you how much I spent with them, but a few $1,000s, right? It's not ridiculous. And you sit down with them and they look at my investments and they tell me, John, I think this is great. I think you're a little exposed here. This I'm not so crazy about. But here's the beautiful thing about it. They don't make any money from me. They make money, I pay them a fee, and then whatever I do in my investments, they're impartial. They don't care. They're not going to make money on it, right? That's the kind of investor I would love for you guys to have, because they don't have skin in the game if you win or lose. These things I see on TV, Fisher Investments and all these, oh, we make money when our clients make money. Okay, fine, you do. But the reality is they're still putting you in something that is going to make them the most money. They just are, okay? I'm sorry. It is what it is. So you don't need a team. Listen, I'm going to preface this by saying you should have a great accountant. You should have a financial advisor, somebody like a Facet or somebody that lets you pay for your advice, not somebody that's gaining or losing by how much you're making or losing in the stock market, right? And a great attorney. Everyone should have those three things. It's your financial and legal team. Go find that team. You need to do that, okay? That being said, once you have your big investment, you don't need you don't need much. You put the money in one of these scenarios, okay? John, you're telling me to put all of $1 million in VOO? Yeah, I'm telling myself, yeah, that's what I would do. That being said, listen, if you haven't figured out, I love doing this stuff. So I have a lot of other investments besides VOO. I just do. My two kids, we have VOO funds. That's 90% of what I invest for them in their IRAs. And then we play around with other stuff. And that's basically how my investments are. And it's what I would explain to my mother and my wife. That's the way it should go. This right here is proven that. And if you go to this report, right, written back in 2015, time and time again, it's been proven by Mr. Estrada. Again, it's proven that a all stock market investment portfolio is most of the time the right way to go. The problem with it, and why I'm not telling everybody to do that, and why I'm giving all these scenarios, is human nature doesn't allow for that. Okay? Ooh, excuse me. Excuse me. Cut that out. Human nature doesn't allow for that. For multiple reasons. A, we can't compute the simplicity of it. We just can't. It's gotta be harder than that. It has to be harder than that, John. It cannot be that easy. That's what our brains think, number one. Number two, when the shit hits the fan, everybody's like, I knew John was wrong. I knew, I gotta get out. And people pull their money out of the stock market. It's the worst thing you could possibly do. It just is. And the reality is most people are that way. That's why I'm going to suggest something like either the Ray Dalio all-season theory, right? Or the Harry Brown permanent portfolio theory. Still very simplistic. Still very easy to do with you and your Ameritrade, Schwab, Fidelity, whatever, Vanguard, whatever your broker is, easy to do these scenarios every single time, okay? You don't need to pay somebody 0.5%, 1%, and then they put on top of that their funds. You know, I'm going to do a whole nother video on just how much your advisors would cost you in the same scenario. I'm not going to do it today. I don't want this video to be 3 hours long. But it's amazing on just getting their advice. Here's the problem. Getting their advice. Listen, if I had to pay somebody 1% of my money and then they made me continually, 10, 20, 30, 40% all day. The problem is the free funds, or basically free funds, are better 9 times out of 10 from what they're going to put you in. A lot of times they want to put you in these complicated things of, don't worry, Sally, you're not going to understand this, but this is really what you should put your money in. No, Jack, I'm not going to do that. I'm going to just be simple, put my money in something like one of these three investment scenarios and watch it grow. And again, okay, so we're talking 15 years from 1 million to 4.1 million. That is the absolute beautiful thing of compound interest and compounding, right? It's amazing. But okay, I'm gonna go down another scenario. The reality is, right, that most people, if they inherited this or if they won it in a lottery, or if they got an insurance claim, or however many ways you could have gotten this windfall, most people need to live on a portion of this, right? So this really isn't a good indication of reality. So we're going to change it. And this portfolio visualizer is awesome for this. But we're going to assume, and listen, the younger you are, the less money you need to take from this. I gave you a scenario of somebody in retirement. They're getting $1,000 from Social Security. They're living $3,000 is their cost per month. They need $2,000 from this scenario. Okay, so I'm going to give you a scenario of an average New Jersey family. Okay, having no other income. This is going to be their income. Okay, assuming you need $100,000 a year to live, because listen, it's New Jersey. So I'm assuming you need $100,000 a year to live. You don't want to work anymore. Okay, so let's go and do this. Let's go into our visualizer, and we're going to go to cash flows. We're going to go to withdraw fixed percentage. Okay, now 0.5%, and we're going to do monthly. 0.5% of our $1 million. What is that? Is that five? Is that 5,000 a month? Sorry. 1 million. Motorcycle going by times 0.5. $5,000 a month. Okay. So times. Okay. That's it. Let's do this. Let's start with this. That's $60,000 a year. Okay. That's a little above the mean of the whole United States, right? So let's assume $60,000 a year. You only have to withdraw from this. You're not investing another penny. Okay. $60,000 is what you need to live. You're taking out $5,000 a month. Let's rework the numbers. Analyze portfolio. Okay, now remember, this is 15 years, even though this is saying from 1985, it's not. Because, again, the portfolios only started 15 years ago. So, again, analyzing from January 2007 to February 2022. Okay, let's go and look. Looky. Okay, 15 years later. Now, look, this is amazing, right? Still a lot of money here, okay? But because you're withdrawing money, your $4 million, that's out the window, okay? So this is an average person, average family. Actually, I wouldn't say average in New Jersey. This is a lower, I don't even know what the right term for, like 60,000 is an average American salary, but in New Jersey, All right, but assume $60,000 a year you've been taken out. So in all of these, you can see in the Boglehead, you have 1.126 left. In the Harry Brown, you have a little over $1 million left. In the Ray Dalio, you have 1.23 million left. And in the Vanguard 500, which is, again, the VOO, you have 1.65 million left. Again, having the higher amount, but having the most volatility. It sounds great, and everybody says, oh, John, it's not a problem. I can handle that. I want to make the money. The reality is, George, when shit hits the fan, everybody tends to run for the exits. So if you are 100% absolutely sure you won't do that, no matter what the stock market does, go with the S&P 500. My suggestion is, because nobody likes volatility, and again, let's go over here and look at the standard deviation, this column right here. Mine is the highest. So that means the volatility of my portfolio is double. The volatility of my portfolio is double Harry and Ray's, okay? And it's a third less than the Boglehead, okay? So if you are risk adverse, which 95% of us are, my suggestion is go with the either Harry or Ray Dalio scenarios, okay? Again, these are self-explanatory portfolios. You can go up here again, look at what they're investing in, right? And do it yourself on whatever platform you have. And feel confident. You don't need somebody back there telling you, oh, Sally, I wouldn't listen to that idiot John. Which, listen, I wouldn't listen to me either. I'm just an idiot on YouTube. But do your own research. And after your own research, Sally, I don't know, your research doesn't look that good. I'd listen to me and be in these 22 different portfolios that are making me a lot of cash. Don't do it, Sally. Don't do it. Okay? So again, here's a scenario of $60,000 a year taken away from my $1 million. Let's up the ante. Let's go to a 1% withdrawal rate every month. And that's going to give us a $120,000 salary a year. And again, I'm assuming you've gotten your $1 million, you don't want to work anymore. Let's see how long this lasts. I'm taking out $120,000 a year. Actually, the reason I did it monthly is it's better than taking out $120,000 in the beginning of the year. You're basically taking out $12,000, no, $10,000 a month for your $120,000. It keeps the money in the market the longest. That's why I chose the 1% and do it monthly. Okay, let's go and reanalyze. Soup-de-doo. Man, I love this thing. This thing's awesome. Okay, so let's take a look. Well, there, Harry. As you can see, not so great. All right, so we need $120,000 a year to live. And that's depreciating. I want you to understand that also. So I'm taking out 1%. And the reason I'm doing it by percentages and not fixed amounts every month is as our portfolio goes down, as we get older, the 1% will take out less. So we're starting at, $10,000 a month. 5 years from now, right, theoretically following the 1%, you're taking out $8,000 a month, right? Theoretically, you're getting further into your retirement, you need less money, you're downsizing, kids are out of the house, blah, 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 same thing. 1%. So you're starting off again with $120,000 salary, okay? So now we are at the Boglehead. We are left with $450,000. Harry Brown, $436,000. Ray Dalio, $493,000. And the Vanguard, again, is the most, $662,000. But again, can't emphasize this enough, the Vanguard is the most volatile. Double the volatility, okay? So, basically, you can go, again, portfoliovisualizer.com, free app or free website, and play with this all day long. And again, so if we go up here, so if you wanted to change it, and it gives you a whole bunch of scenarios, right? Equal weight, normal weight. You can put your own, let's say you have 10 stocks that you're already investing in. You could go down and do it, let's see, oh, here we go. Upload your portfolio, and it will allow you to analyze your numbers. This thing's phenomenal, right? But I like these three scenarios. These three scenarios, after testing a lot of these, gave the best performance, okay? The best scenario as far as least volatility and most money. Again, the VOO, S&P 500, gives you the most bang for your buck, but buddy, get on board for the ride. This buck is going to throw you into a loop. Okay, so unless you're prepared for that, I would tell my wife, if I passed away, or my mom or my sister, go with the Ray Dalio, right? Go with the Harry Brown. Harry Brown's a little easier, a little more simplistic. Ray Dalio, again, it's five different funds. So the guy's a genius. He managed trillions of dollars. It's phenomenal. Okay, so I hope you guys got a lot out of this. If you have any questions, make sure you ask. But basically, and don't forget to subscribe. Hit the little bell so I come across your little TV. I know, listen, I know I say it every time, but I'm trying to build something here, people. I really am. I want to help as many people as possible. I take this for granted. I just love doing this. And more people need to understand and more people need to know how easy it is to set yourself up for your future. And if you hit that little subscribe button and the bell, it just helps me get to more people because it activates the algorithm in YouTube and says, hey, some people are liking this. And it puts me in front of more people. So that's all I ask. I'm not looking for money. I'm not looking for you to buy anything from me. All I'm looking is for you to spread the word for me as much as you can. Okay? So, that being said, we'll see you on the next one.
I'm gonna be a millionaire. I got $1 million. It's in my hot hands. What should I do with it? Well, I just told you.